Good day, all. Ira Epstein with your financial market wrap-up for this Sunday, and we are now January 30th, football day. I know most people will be glued to their sets. I got up at 3:30 watching the Australian Open. Then I watched the end of the Daytona 24-hour races that were going on, the kickoff to that. Now I'm going to football. Can you imagine? I'm exhausted. That's putting it mildly. Now, we did get some news over the weekend. First of all, we had the Baker Hughes data that came out on Friday. We've been adding some wells. When you look here for Monday, we have the Dallas Federal Reserve Bank coming out with their monthly regional outlook, Chicago Fed PMIs coming out, and we also got China's National Bureau of Statistics with data. And as you can see here, if I step back just a fraction for you, you can see that they have been slowing down. No surprise, the Omicron, and it's probably going to get a little worse because they're in their lunar holiday. How could it pick up during the holiday when basically the whole country takes time off? So that'll be a little bit slower as well. When we go to the chart action, you're in a correction mode, as you can see, and on a monthly basis, the word is monthly, you're down from just closes, from the high close to the low, 7%. That's not the high of the month to the low of the month. It's on a closing basis. When you take a look at a weekly area chart of closes, you are down as well, and you came up this week, but you're still overall pretty much down. You had a high close of 47.58.50, and now you're down. Last week you had closed at 43.90, so it was a heck of a break that you had in the market, over 300 points, about 9% on a closing basis. We then go to the weekly bar charts. And as you can see, you got a 4,800 high, a 4,200 low. So you had one heck of a break in the market. I mean, just you do your multiples. 15 times 48 is what, 900 points. So you didn't get that much, but it gives you an idea of the size of the break as to where you're at. The pattern is one of a higher high, lower low as measured by the swing line. Now, let me explain the swing line. This line always connects to either the prior bar's high or low. So it's either going to go from that bar, the prior bar, to the low or the high. There's 5 rules that make it up. I teach it in my charting course. And the purpose is when you look at a market, you see is it trending. An uptrend should have higher lows, higher highs, or a downtrend, lower highs, lower lows. You don't have that. You have a higher high, lower low with the steep break, which I call a vertical price break. And the reason it's vertical, it doesn't give the traders a shot. When that occurs, it's often making weekly lower lows, and it just keeps falling on them. That's why it's vertical. When we take a look at other moving averages, I've got the 200 week, I've got the 18 right here in red, and I have the 100. So in looking at it, if the market were to keep falling, the next support on a moving average basis would be the 38.20 level. Now, my theory is this. When a market is over the 18-day average and it wants to pull back, it often finds support right against that average. It did that up until the past 2 weeks. And then, not this week, the week prior, the market broke through a prior low. And now, this week, it didn't even try to hit it. That's a change. It is a watershed event. We have not done that. The further back I step, I can take you through last summer. You didn't do anything like that through June. So we've seen another event that has shifted in the market. Now, people will ask, well, is that the shift? First of all, you never worry about if it's the shift. It's a shift. And until these highs are taken out, you have to assume that the market is got in question whether the buy the dip mentality has gone away from the market. I personally think for the moment it has. I think it'll come back. My rationale is I don't think interest rates are going to gallop as high as people do think in the end. I think that when you get your price earnings ratios, which are right now in the S&P about 19.5 versus just December was 22, the 5-year average is about 18.5. Admittedly, the past 5 years have been bullish as can be. So that could be an elevated number too, but you're getting to a zone where you might start getting interest for those buy the dip, but I don't think it's enough with the headwind of rising interest rates, just major meeting after major meeting ahead of you just yet. Therefore, My scenario as a chartist is I'm going to look for resistance at the 18-week average of closes. That's what I'm leading you up to. That's where I think the pros will show up with shorts. What about support? Well, see these black bands? 95% of the time you will trade within them. The first time you hit one of these bands, it's an area that I teach in my courses that the pros show up to cover. Now, something else is important. When's the last time you hit that in an S&P? Not even through the summer of last year. Not this past year. I'm not talking the current June. I'm dealing one prior to that. That's a big event. That means the market has changed its character. It just didn't happen. In the past, you were rewarded if you bought the 18-week average on pullbacks to it. This time it punished you. So the buy the dip mentality has left the market for the whatever period of time. Resistance, I'm going to look for it there. Momentum is still pointing down. You're not trending as you have a higher high in a lower low pattern. When we come to the Dow, it's not the same story. This market had been hitting the lower band, the sign of weakness. The Russell had been hitting it as well. So you've got to pay attention to which markets were on the weak side. For a long time, the NASDAQ had not, but then it started doing it. You'll see that in a minute here. This is the same picture. It is a market without a trend. It doesn't want to stay under the band. It is rewarding those that do short covering against it. My theory is you're never a net buyer at the band on futures. You're looking for bounces, but you're looking for the resistance in bull markets to first show up here. The problem is I don't think we're overall in a bull market now. Therefore, I'm looking for even more resistance to show at that number, period. In the NASDAQ, notice you had not hit this number. So it was just like the S&P. That has rolled and shifted as well now. And again, you've got that higher high, lower low. And again, traders that covered any shorts they had at the Bollinger Band found themselves in safe company. The market really didn't keep going down and staying under it. Momentum is still pointing down, though. The market that's the weakest has been, consistently speaking, at least from my point of view, and I've talked about it, the Russell. Now, admittedly, it did have that one stick up there, and it did. And that caught traders, and it was a head fake, as it turns out. It meant nothing in the scheme of things. You went not only from that, you've made new lows. So whoever was driving that market got themselves caught in the market. I don't know if they're still in it or not, but the stocks that make up this index have done terrible. And it's the only one that is down to the 100-week average. So it's a weaker chart, the weakest of the group. Momentum's still down. All four do not have a pattern of lower highs, lower lows. They're not trending. They have one of those patterns of a higher high and a lower low. In the 30-year bond, you're in a bear trend. I would be surprised if we don't attempt a cross down where the 18-week average in red gets under the 200-week in time here. That's what I think the market is trying to work at. Remember, it's a weekly chart. It doesn't have to happen this week. It's not like the dailies where they go 1, 2, 3. But I think the pros are waiting for this market, and I think they'll be aggressive selling into that area with stops that are far away at 164. But what's going to make the market get up there? That's the thing. I guess it would take a Ukrainian war that the U.S. gets dragged into in some manner with troops and bad things and threats of nuclear and who the heck knows to get that up. Yeah, that's what I think it would take, some crazy event all the way up there that I don't know about at this point in time. I'm guessing the Ukraine. It could be other events, but I'm just guessing because it's the thing on the table. 10-year note, same theory. Trend down, bias down, but you're not going to stay under that band more than 5% of the time. So you move to the right-hand side. That's what the pro understands. The algorithm will do that over and over and over the way it's built. It sometimes is a mixture of price going sideways, the algorithm falling. But you'll see that over and over. Well, if the dollar's going up like that, what do you think's going on in the eurocurrency? Because it makes up 40% of the dollar. It fell down to the lower band, and that's where the market should try to find its support. It's going to get short covering, in my opinion, there. doesn't mean it's new buying. Short covering is very different than new buying. So I can make an argument that that's there. This was the contra trend rally to the upside, and it didn't quite fail at the 200 and the 18, but it certainly failed at the 18-week average of closes. In the Canadian dollar, this market got itself all messed up. Typically, earlier in January is when a high probability of a seasonal break takes place. It missed it completely. It was delayed by about 10 days, and that was the break that the market did. So now the question is, what is it? Well, we have the trend up, but the bias is now down since you're under the 18-week average. To reinstate the bullishness, you've got to close back over 79.26, the 18-week average of closes, and not take out 78.02 and a half. Momentum also has to turn. Can anything turn the chart bearish? No. Even if you take out 78.02, you'd have a higher high and a lower low. I do see a case for a lot of support, however, from 77.41 to 77.26, the combination of the 100-week and the lower Bollinger Band. The Japanese yen, all the safe haven buying off the Ukraine came out of the market. That's basically what this is saying. So you had that contra move up, culminated again at that line in the sand, and right down just about to the Bollinger Band. It's about 17 points away. It wouldn't surprise me if it hits it this week. But again, I'm not seeing a trend. Now in Bitcoin has tied itself to the stock market to a degree. I couldn't begin to tell you why, nor do I care why. I care that the coefficients, and if you look for how it's tying itself, you see that reading. I see support at the lower band down to the 100-week moving average of closes. That could be reason to come out of the shorts. That I'd accept. It is not a reason to be a buyer in the market. Momentum down, bias down. You've hit for the first time your downside target since all the way back here in May and June, and that rewarded the traders if they came out of shorts and waited for their buy signals. In the energy complex, the big question is going to be in this market, number one, is there a number that energy gets so high it shuts off world economies? That's the first thing. You can see Brent is still gaining on WTI. The higher the number goes, the bigger the difference there. I would be watching this week's past lows. If they're taken out, I think it's a good indication that the market's going to return, whichever market takes out those lows, because most of them had outside weeks up, back to wherever the 18-week average of closes in across the board. Until then, the trend is up. The upper Bollinger Band is the resistance in all of them, but I'm giving you the way that I'd be looking at them and the way that I'd want to handle them. Now, if you're a serious trader, I want to be the guy that in the morning, you open up your computer and go, okay, there's where the markets are. What's Ira thinking of those charts? And to do it is so simple. At 5:30, 5:40 in the morning, p.m. Central Time, I record the futures. I'm recording 40 charts. Sometimes I'll talk weekly, sometimes daily. On the weekend, it's always the weeklies for the longer-term trader. But Monday through Friday mornings, it's typically a mixture of the two. Then, after I do the futures, I move to the spider and ETFs. And the reason I do it, and I wait a bit to put that out, because I want the morning market reports to come out. Most come out in the United States between 6 a.m. and 9 a.m. I want to get those out for my traders. Then I start covering the spider ETF. I like the first 20, 30 minutes to go by in spider ETF trading right off the bat before I tell my clients to do anything. The reason is let the money from the overnight trade catch up with when the actual trade picks up there. You know, there's off-market trading and other things of that nature. I find that's the smart move. And then from there, I start covering all this for you. So between the two, you've got a full picture as to what I see on a technical basis, the news that goes with all of it, how it all works, what you do with it. How do you get started? It's simple. Just go to our website. Under the word research, go right there. It explains how everything works, and you can watch the videos. I'm Ira Epstein. You have a good day. I will see you all. That'll be tomorrow. Take care now.